This episode is brought to you by AARP. 10 years from today, Lisa Schneider will trade in her office job to become the leader of a pack of dogs. As the owner of her own dog rescue, that is. A second act made possible by the reskilling courses Lisa's taking now with AARP to help make sure her income lives as long as she does. And she can finally run with the big dogs. And the small dogs, who just think they're big dogs. That's why the younger you are, the more you need AARP. Learn more at aarp.org/skills.
You're listening to a Mint podcast brought to you by HT Smartcast.
Hello listeners, welcome to the latest episode of Why Not Mint Money. I'm your host Jash Kriplani. Recently, Sebi came up with a new fund category called Hybrid Passive Funds. Well, what does this category means for investors, and will this category add real value to an investor's portfolio? In today's episode of Why Not Mint Money, I'm joined by Arun Kumar, who is Head of Research at FundsIndia, to talk more about this.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Arun, welcome to the latest episode of Why Not Mint Money. It's really great to have you here. So Arun, we wanted to connect with you today about new category that Sebi has plans to launch called Passive Hybrid Funds. How do you think this category can help investors?
Hey, hi, Jess. Thank you so much for having me on the show. See, I think broadly this was expected, because if you really think about it, the idea of passive funds is that it simplifies the life for, especially if you are somebody new to investing. There are so much of choices that it becomes very intimidating for a lot of us. So passive by its nature is a very simple idea that there's a very simple rule where larger the better is broadly what is being called as passive. But in all other practical terms, it's just that you want to go by some rules which have kind of worked over long periods of time. While there are different rules, passive predominantly refers to larger the better. So which means a stock with larger market cap or free float market cap, you give it a higher weightage. So this was the broad idea of passive, and did a similar thing on the debt funds as well. But again, you only had solutions for 100% equity or 100% debt. So it was logical that you have a mix of them, because different people might be on different spectrums of risk. So there might be somebody who wants a slightly lesser equity exposure and somebody who wants a more higher debt exposure. So I think these three broad categories, where equity at 75%, equity at 50% and equity at 25% broadly covers the predominant spectrum. There can be plus or minus 10%, but from a very simplistic point of view, these three equity allocation more or less kind of cover almost the entire spectrum. So I think it's a very, very good decision. And also from a taxation point of view, if you are at 75% equity, then you get equity taxation and you don't need to worry about the rebalancing part. And so this goes one level above the original pure equity debt passive, and you also solve for the rebalancing part of it. So it almost becomes like a simple one decision portfolio.
And, there are, like you pointed out, 75, 50, 50 and, 25 equity. So, which investor is more suited for which category according to you?
See, I think for somebody who is just broadly entering the market and is very confused, passive makes a good starting point, because all said and done, active funds require two levels of knowledge. Level one is to understand what is the strategy of the fund manager, what is the investment style, and then try and put together different investment styles. So this is the first knowledge part of it. But there's also the behavioral angle to it, where all active funds which are following a particular style will have to go through underperformance at some point in time, but there will be environments which don't favor that particular style. Now it's very hard for a normal person to figure out whether the style is going through an environment where the style is not a problem, but it's just that the current environment, the fund is underperforming because of the style going out of favor. Vis-a-vis genuinely something going wrong, where the fund manager has taken some wrong calls or has not been able to stick to the style. So these are slightly nuanced calls which might be a little difficult for a first-time beginner investor. So I think for them, a passive is a very good starting point. If you cannot do all this, or if you're very confused, then passive becomes a good starting point for them. And again, you can look at it in terms of one time frame. So if you have a very short time frame, you go purely into debt. Say if you have 3 to 5 years, you can probably try a 25% debt. And let's say if you are more than 5 years, then you can go either 50-50 or 75. And let's say if you are more than 10 years, you can comfortably attempt even 100% equity allocation. So time frame can be your one angle. The other thing is purely to look at what can be your tolerance for declines. Now, obviously, it's very hard to predict when equity markets will go down. But historically, when we did a study of Sensex for the last almost 43 plus years, we found that almost every year there is an intra-year fall of 10-20%. And once every 7-10 years, there's been a large fall anywhere between, say, 40 to 60%. So for any equity investor, by default, you can assume that there will be 10-20% falls every year. And once every 7-10 years, you should be okay to see your portfolio down by 50%. Now, once you put these in terms of numbers, so let's say you have 10 lakhs, you can mentally say that I should be okay for it to come down to say 8-9 lakhs every year. Again, on the worst case, it can even go down up to say 5 lakhs, right? Which is roughly a 50% cut. Now, this might be very hard for somebody to digest. So based on that, you can add more debt so that your overall decline in your portfolio is much lower. And then the third step would be to put a math around what is the return expectation. And then say, if I am adding more debt, there will be a slight compromise on returns, and what is the long-term potential returns that I might be losing. So overall, if you can bring together your time frame, the downsides that you are required to put up with, and the long-term opportunity loss that you might have to take because you are adding some more debt, now you can come to a broad sense of which is the allocation that you want. But if you want to keep it really simple, the lesser the time frame, more debt; the longer the time frame, more equities. But I think if you have anything above 7 year as a time frame, a good starting point would be to go for the aggressive 75% equity, and 5 to 7 years would be 50-50, and less than 5 years or 3 to 5 years would be the 25% equity allocation.
And Arun, like you yourself have been a known 80-20 investor, and you have a successful blog, and of course you talk a lot about asset allocation. So in that context, this kind of fills up those asset allocation needs, right, for a simple investor, and you have been a big advocate of keeping it simple also.
Yes, it makes a lot of sense to keep it simple, and this is a perfect product which almost kind of solves all the problems, right? In terms of fund selection, in terms of rebalancing, it solves all the problems. The only nuance that I would add is that once you reach a reasonably large portfolio, maybe that you can define as at least 5 times your annual expenses. I mean, you can have different permutation combinations of what is a large portfolio, but as a rough cut, how much do you need as expenses every year? And that as a multiplier of your portfolio. So, and if you're reasonably young, so till the time you reach a large enough portfolio, I think it makes a lot more sense to be a lot more aggressive on equities, because there are two things. One, when you start, your savings is actually a very, very small component at that juncture compared to what all you will start saving over the next 10-20 years. So if you look at your portfolio at 25 and just do a rough math of what can possibly be your incremental savings over the next 10, 15, 20 years, most likely you will find that the portfolio value is a very small component. So the key point is when you start thinking about asset allocation, make sure that you also include your own human potential savings, which are going to accumulate over the next. So you might have a 10 lakh portfolio when you're 25, and you might want to do an asset allocation there, but you also need to put into context that probably you might be adding 1 crore or 2 crores over the next 15-20 years based on your salary growth and earnings. So once you put that, then your 10 lakhs becomes incrementally very small. And then to do an asset allocation on top of it might overcomplicate things. So the idea is when you are young and when your portfolio size is reasonably small and you have a long career ahead, reasonably keep allocations very high to equity, and over a period of time, start focusing more on the asset allocation part, because the same decline of say 10-20% or once in a 7-10 year period where you hit the higher 50% decline is very okay if you have a smaller portfolio. At 10 lakhs it's still manageable, but maybe at 5 crores it's far difficult, because the numbers become very large. So for all of us, we have different threshold. The same 20% decline might look very different at different portfolio values. So my sense is just make sure that don't overdo asset allocation at your early stage at lower portfolio sizes, but over a point in time this becomes very critical, and especially when it comes from the industry. Most of us deal with very large clients, so there is an inherent tendency to overemphasize asset allocation. So just make sure that the overall equity allocation is reasonably higher during the early part of your career.
What would you say, even for early part, 75 or 80-20 loosely is what you start with, even if you are just...
75, or even if you can do, say if you're doing an SIP and you do a 100% equity also, it should still be fine, because all said and done, you are technically 90-95% is actually your own savings over the next 10-15 years. So you would look abysmally small. If you ask anybody who is at 35-40 saying at 25 what should you have done, you would inevitably come up with the answer that I was overcomplicating things. So my sense is don't overdo the asset allocation stuff early on. But I think for medium, or for people who have built a reasonable corpus and who are probably in their 40s, I think gives a very good bouquet of choices.
And also you will have with this category two kind of routes. One will be ETF, one will be index funds. What would you recommend? And also from tax perspective, ETF, if I'm correct, will be taxed differently, right?
I would prefer the index route. The ETF, again, you have this issue that some point in time the pricing sometimes is a little higher than the original underlying NAV value, or sometimes it's even lower. But there are liquidity issues that crops into ETF. So unless and until you are a trader who is trying to buy a Nifty 50 ETF in the morning and trying to sell intermediary during the day, I think for most of us, the index route is a far more simpler route. And anyway, this is an asset allocation product, so which is by nature long term. So I would prefer the index route over the ETF route. And there is no taxation differential between it's purely based on the underlying product. Either it's debt or equity. So there is no tax differential between both. So I think index works for 99% of us.
Thanks a lot, Arun, for joining us today and sharing all those insights. Thank you, listeners, for joining us today. If you liked this episode and would like to hear two more such interesting conversations, do log into our channel, Why Not Mint Money, on Spotify as well as other platforms, where you will find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI, or y'all can always mail to us at mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.